Okay, so it's 11 a.m. I'm hoping everyone can hear me. I've been having some audio problems, but hopefully we've got those licked. So we might as well get started. So I want to welcome everyone. My name is Dr. Kent Fellows. I'm a research associate at the School of Public Policy in the Energy and Environmental Policy Division. And so I'm happy that everyone can be here today. The School of Public Policy is Canada's leading policy school. We're known for our practical research and for bringing people together, even though right now we have to stay apart, to discuss important issues with experts like Richard, who we've got with us here today. I'm very pleased to be able to welcome you to the first in what we hope is going to be a new and exciting series of webinars hosted by the school to provide expert commentary on issues that are impacting all of us on a daily or even on a longer term basis. In today's webinar, we're going to discuss the impact that the COVID-19 pandemic and the corresponding oil price war are having on the Canadian energy sector. And so we're very pleased to have Richard Masson with us today, who is Richard is an executive fellow with the school. He's got over 30 years of leadership experience in energy product development and energy marketing. Currently, Richard is the Chief Commercial Officer for Fractal Systems and Chair of the World Petroleum Council Canada. Richard's going to start us off with about a 10-minute talk to give a briefing on the issue, and then we're going to address your questions. If you've got questions, please type them in the Q&A box below the screen or at the bottom of the screen. I'm going to moderate for Richard so we can make sure that we're not answering the same question 2 or 3 times. So I'm now going to turn it over to Richard to give us his 10-minute briefing. Take it away, Richard.
Thanks, Kent, and I'm glad everybody's been able to join us here this morning. It's great to be trying something new in our environment where we're all trying to stay apart and still make sure that we carry on as best we can. So last week, we were asked if we could provide some thoughts on how Canada might deal with the crisis that we're facing in our petroleum sector. And we put our thoughts to that and came up with a short paper that was released earlier this week. And what I want to do this morning is just walk through that with you and provide a basis for discussion, questions and answers about, what's the problem that we're facing? How big is it? When might it resolve itself? How do we get from here to there? So let's just start with, framing the size of this issue. So Canada's petroleum sector, its oil and gas sector, is the largest exporting part of our economy. And, quite a bit larger than autos. We often don't get credit for it. A lot of people don't understand how important it is. But it's important to Canada overall, and we earn a lot of export revenue from it. And for Alberta, it's the largest part of our economy, being about 27% of our economy in 2018, which is down from what it used to be. We have diversified, but it's still a very big driver for the health of Alberta's economy. So what started to happen on March 13th, which was a Friday, there was a meeting that was held between OPEC and its associates, mostly Russia, and it was called OPEC Plus, and it happened in Vienna. And at that point, COVID was just starting to be on the horizon. And the oil-producing nations looked at this and said, demand is going to go down for refined petroleum products for oil. We're going to need to cut supply to keep the market in balance. And the Saudis took a pretty bold position. They said, if we can cut globally 1.5 million barrels a day of production, which is about 1.5% of the global production level of 100 million barrels a day. If we can do that, we think we'll be able to balance the market. And we as OPEC are prepared to do about 1 million barrels a day of that, which would be mostly Saudi Arabia. If Russia, you are prepared to cut in the order of 500,000 barrels a day. And a lot of folks going into that meeting expected that would be what the outcome was. But it turned out Russia balked. They said, no, we're not going to cut production. We think that the US has been ramping up production too much in Texas from the Permian, from fracking. They've been taking market share from us, and we're tired of cutting production to let the US grow. So no, we're not going to do that. The next day, Saudi Arabia essentially said, well, if you're not going to play ball with us, we are going to turn on the taps. And so we will take our production up by about 2.5 million barrels a day to a record level, 12 million barrels a day. And we are going to gain market share ourselves. We are the low-cost producer in the world. We're tired of taking the production cuts ourselves. And Russia said, fine, we're prepared for that. We're also going to increase our production 300,000, 400,000, 500,000 barrels a day. And so we end up with a big new source of production coming onto the market. People at the beginning of that thought, oh, this is going to be bad, and prices started to go down. But we recognized pretty quickly that prices were actually going to get worse. And so you can see this chart here. Let me just do this. Hopefully folks can see the oil price chart and the steep, dramatic decline. As analysts have looked at what's going on over the last couple of weeks and realized what's happening to the economy as we shut more and more places down. So first it was China, Korea, Japan, Italy, Spain, New York. You know, we're all stuck in our homes, and that's growing and growing. And so that's really tanked the demand for refined petroleum products. Airlines aren't flying anymore. You know, people aren't driving. And so estimates as of last week were that petroleum demand would be cut by about 8 million barrels a day by the end of March. I've seen this week people expecting it'll be about a 14 million barrel a day cut by the time we get into the second quarter. So huge disruption in the demand for petroleum products, something we've never seen before. So we have this dual challenge of 2.5, 3 million barrels a day of new production coming on stream and a huge decline in demand. So what does that mean? Well, the Saudis, they discounted their prices. They're sending their oil out. It's heading all over the world in tankers. Prime target is the US Gulf Coast refineries. That's one of the biggest refining centers, the biggest refining center in the world. And so all this oil is landing and filling up tanks there. And the refineries themselves don't have a place to sell their jet fuel, their gasoline. And so those refined product tanks are filling up as well. And so as we go through the system, the tanks in Houston fill up, the tanks at Cushing, which is in Oklahoma, fill up. That's the main storage hub for North America. The tanks in Hardisty, where we ship our oil from down to the Gulf Coast, were already pretty full because of all the issues Canada's been having, which I'll get to in a minute. And so we have a very dire outlook for the whole system right now because there's so much oil being produced and only a limited amount of storage. I've seen estimates that say we could be adding 20 million barrels a day of storage, 20 million barrels a day to storage right now, and filling it up very quickly. Estimates are that there's not enough room to put all this oil before this resolves itself. There's going to have to be some dramatic production cuts. So it's a big imbalance, and crude prices are reflecting that. And we've seen WTI prices in the low 20s, and in Alberta, we've seen Western Canadian Select, which is our benchmark for heavy crude, trading in a range of $10 a barrel, some days $8 a barrel. And I'd like to note that $8 a barrel for WCS, Western Canadian Select is made up of heavy oil plus light oil, which is called diluent. And so a good chunk of that value, $10 a barrel, is actually the value of the diluent that's required to move the oil down the pipe. So bitumen producers are seeing netbacks of $5 or less some days these days for their actual oil that they're producing. So very, very tough times. So how is Canada set up for all of this? Well, we know that we were having a very difficult time over the last number of years. So in 2013-14, things were very good. Canada was seeing a lot of investment in new projects in oil drilling. There was about $80 billion a year spent in the petroleum sector on new capital investment. That generated jobs across the country. We can remember people flying in on dedicated planes from the East Coast, from BC, from all over the place, supply chains that reach deep into Ontario and Quebec, all working to satisfy the demand for oil in the world. Then production cuts happened, and we ended up dropping quite a bit. So by last year, by 2019, overall capital investment was down from $80 billion to about $35 billion, a big cut. That resulted in a big adjustment to the overall petroleum sector. Some companies went out of business. A lot of companies had to tighten up their capital budgets. Some of the drillers, some of the service companies were able to move some of their activity down to Texas, where they were drilling a lot and fracking a lot and growing their production. But all that is, been one big challenge for us as we have adjusted our economy to get leaner and more efficient. In the current environment, oil companies have to deal with the cash flow they have. We haven't been able to raise new equity for a couple of years. In fact, In Alberta, the Alberta Securities Commission did a report recently that said in 2016, their issuers raised $12 billion of new offerings. In 2019, it was down to $2 billion. So equity markets, capital markets have been closed to new oil and gas investment. So producers have to live within their cash flow. And now with these lower prices, cash flow is going down, and they're going to have to cut back. So what we saw last week when we wrote the paper was $4.5 billion of announced cuts. As of today, it's over $6 billion of announced cuts. What does that mean? Well, it means producers aren't spending on drilling, they're not spending on services, they're not spending on capital projects, they're slowing or mothballing capital projects, and that flows to the service sector. So the drilling companies, the frackers, the engineering firms, the fabrication firms, that means immediate hit to their businesses. And those firms are already in a pretty weak position, as I said. There used to be an option to move to the US and look for work. That option is essentially closed because the same problem is happening for the US sector. And so we have a lot of pressure on the producers and the service sector, the whole chain here in Western Canada of the oil producing sector. So we're looking at, how can we help? And I think the big question is, there is a viability to the oil industry long term. So we see that around the world, producers cannot be viable at a $25 WTI oil price. We know that this is all about a price war between Saudi Arabia and Russia that'll resolve itself at some point. And we know that it's a lot due to a sharp demand drop while we all stay at home that hopefully will also resolve itself at some point. So there will be another side to this valley. And the question is, how do we get from here to there? So the suggestion in our paper was government involvement, providing some type of funding. It could be in the form of debt with flexible repayment terms. But the challenge with that is a lot of producers already have a lot of debt on their balance sheets, and that just exacerbates their ratios. It's unlikely governments would want to get involved in buying shares of companies, and companies may not be keen to sell shares to government at these very, very low valuations they face right now. So our suggestion was perhaps a hybrid, which is called a preferred share. Preferred shares allow, they count as equity on a balance sheet. If you do this structure where it's a dividend that's earned but only paid when the company has the cash flow, called a cumulative dividend, provides some flexibility when you don't know how long the valley is to get across, and it probably could be a potential solution. So that was really what we were looking at: is government probably has to help our producers survive. What I would say in the global context, probably 70% of the world's oil is produced by Crown-owned oil companies. Saudi Aramco is owned by the Saudi Arabian government, and those types of companies are already backed by their government, and they have the ability to bring government funding into the mix and survive this downturn. There will be other places, Venezuela, Iran, that are already under sanctions, where production is declining already because they just don't have the cash to keep things going. And so there's going to be a big shakeup in the world. And part of our question strategically as a country is, we sit on one of the world's largest oil resources. Do we want to be able to still produce it once we get to the other side of this? Or how painful do we want this whole transition to be? So maybe I'll wrap it up there, Kent, and just open it up for questions. But that's kind of the thinking behind what we were putting out in the paper this week.
Thanks, Richard. Yeah, I mean, I think you've spelled out the situation very clearly, and also, your potential remedy, or at least bridge to get to the other side. So we've had a question come in over the Q&A through Zoom here. So I'll just read that out to you. Do you see coordination of production cuts within North America? The context is that the commissioner of the Texas Railroad Commission is talking about restricting Texas oil production. Could there be some correlation there between U.S. regulators, Alberta regulators, Department of Energy, AER, and maybe the BC Oil and Gas Commission and others? Do you think that's a potential way to reduce the harm, at least in North America?
That's a great question. And so maybe I'll go back to what we did in Alberta probably 14 months ago or so. So after bitumen prices really dramatically declined in the fourth quarter of 2018, Alberta decided that it had to implement curtailment. And it had never done that to my knowledge. But what essentially it said was, we are going to force producers to remove 325,000 barrels a day of production from our total production of 3.6 million barrels a day, because we don't have enough pipelines or storage. You know, if you don't have pipelines and you don't have storage, something's got to happen. And the price had really declined to really, really low levels. So Alberta took the action and said, we are going to force companies to reduce production. We're going to tell them how it has to be done. The alternative to that approach was to let those who have the highest costs or the weakest balance sheets essentially go out of business or cut production, and let the strong carry on and the weak go away. So two different philosophies on how to deal with this. The Texas Railroad Commission has the same kind of power that Alberta has. So they were originally, it was Texas Railroad Commission because in the old days, all oil moved by rail. They hadn't invented pipes yet. And the Texas Railroad Commission was put in place to manage production at the turn of the last century in Texas. So they have the ability to curtail production. They got huge pushback when that idea was surfaced in the last week, because producers don't want the government involved in their business. You know, some are well positioned to get through this. They have put in place hedges, they have strong balance sheets, and they look at this as an opportunity. They say, well, if the weak are going to go out of business, I'm going to buy their assets cheap. I don't need a government agency coming in and telling me that I have to cut my production so some other fellow can survive. And so this is the big challenge. And then, of course, we have another challenge, because Texas is a big part of the problem. That's where a lot of the growth has been. But there's also Louisiana, and there's offshore production in the US and other places. So, you know, Alberta on its own with the cut we did, and anything we could do, is too small to make a difference in this. Texas and the US overall is bigger and, you know, can be part of the solution, but it's a very complex thing trying to figure out how do you allocate it, even within Texas, let alone amongst the states, and how do you do that in a way that's going to see a positive response from Saudi Arabia and from Russia.
And I'll jump in and exercise my moderator's privilege here a little bit and say, I mean, the other issue is, right, and then the question alludes to this, companies can't do it on their own, because if you get multiple companies that come together and coordinate a production cut, that's generally going to be in contravention of either the Competition Act in Canada or various antitrust acts in the US. So it really has to be a regulatory thing, and I think you've painted that out quite well.
Right. Good point.
So we had a couple of questions that were similar, so I'll kind of group them together. So the first one is, at these price levels, are we seeing production shut-ins yet? If not, why not? And then related to that, you know, which firms are all the firms going to survive this? If not, which ones are the ones that are likely to suffer or go under, that don't make it through to the other side?
We have seen some modest production shut-ins so far. So if I recall, Baytex is one that may have shut in 3,500 barrels, and I may have the company wrong, but there's been small things like that. And then Suncor, when they made their announcement, they're the operator of the Fort Hills oil sands mine, which is a large mine. And Fort Hills was already suffering from curtailment, just the way the formula worked. They weren't allowed to reach full capacity. So they were running at less than full capacity, and they have 2 trains production. And Suncor essentially said, to try to become more efficient, we're going to shut down 1 train completely. So the production declined because of that, to try and just manage costs. So those are the ones that I'm aware of so far. Let me make the bigger picture comment. You know, in Alberta, we have 500,000 barrels a day of conventional oil production, you know, conventional wells, or those type of wells that are relatively easy to shut in. Some of those things will be shut in quickly. They tend to produce lighter oil, so they're not as impacted as bitumen in terms of price, but those will be the easier ones to shut in. When you think about oil sands projects, which is where most of our value comes from, most of our production, they're big integrated projects. So a SAGD reservoir might have 70, 90, 200 wells in it. And a lot of times they'll try and manage the reservoir as a unit. So they're trying to put steam into certain places, pull water out, keep the reservoir properly heated in order to make it as efficient as possible. As efficient as possible it is, the lower your costs, the lower your greenhouse gases, all of those things. And trying to shut in those complex reservoirs is difficult. In addition, when you've got a lot of surface facilities, steam facilities, those type of things, if it's in the winter time, and it's still mostly winter up north, you've got to worry about freezing. So there's a lot of complex things to think about just to actually do it. And even when you do it, you still have a lot of fixed costs to manage. So you get away from your variable costs, which saves you some, but it's not a huge change to your overall profile. And then the biggest problem, of course, is we don't know if 3 weeks from now, Russia and the Saudis are going to come to some kind of agreement. And so shutting in a big oil sands project takes a bunch of time and a bunch of money, and you may do it and find that you need to restart right away. And so producers have been very reluctant over history to shut in these big projects. And one of the things that they really need to get their heads around, I'm sure executive teams and boards of directors right now are looking at hard, is how long will this last? Because if it's going to last 6 months or 9 months or a year, then it may be that we start to see some of these big projects get shut in. Or if they think the government's going to try and curtail them, maybe they want to take action themselves. So there's a bunch of things, I'm sure, very difficult conversations going in downtown Calgary right now trying to address this issue.
Yeah, and so I'm going to steal a little bit here from a conversation I had with Blake Schaefer, who's faculty at the University of Calgary and who I think is watching right now. I mean, if you look at some of the forward curves, right, for oil prices, there seems to still be an expectation that there's going to be some price recovery. Is that overly optimistic? Is this irrational exuberance? Do you have any comment on that sort of?
Well, I don't think anybody knows too much, and forward curves are interesting because you can actually trade and hedge at those levels, which is helpful, but they don't always work as great predictors. And one of the biggest challenges right now is because there's so much oil, the near-term price is very low, but the forward price hasn't dropped as much yet. So that does give a signal that we're going to get through this and it'll start to resolve itself, which is one reason why companies might want to continue production. But it just may be that there hasn't been enough pressure at the front end of the curve to push the back end of the curve as far down as it's actually going to go by the time we're done with this.
Yeah, that's a very good point, and one and near dear to my heart that the forward curve is not a forecast, and oftentimes, sometimes people try to treat it that way. So another question from the Q&A. From your perspective, what are some tools, if there's diplomatic tools or sanctions or whatever, that the government of Canada can take to help alleviate the price war between Russia and Saudi Arabia? I mean, are we sort of the ant that's trying to avoid getting stepped on here, or do we actually have some recourse to push back? And I know that's a little bit of speculation, but I'm wondering if you can comment on that at all.
Well, one of the things, one of the roles I have is with the World Petroleum Council. So Canada is part of a 65 nation organization, and I get to go to conferences and see lots of different things. And it's interesting when you're in that context to realize how small a player Canada is in the world, in the petroleum world. Despite the fact that we sit on a very large resource and we actually have a lot of production, 4 million barrels a day of oil, plus liquids, plus gas, we're a significant producer in that way. We're landlocked, right? So our only real customer is the US. And from a global perspective, we're just not on the radar of anybody. We don't have, we don't sell into multiple markets. We don't have the ability to ramp up or down production easily. And so when you think about the price war that's happening between Russia and OPEC, Saudi Arabia mostly, we're not relevant. We just aren't part of that conversation. We have no tools to use. If we tried to cut production, the cut that we would make wouldn't, it might be a moral support for them, but wouldn't make a real difference in the global supply.
So that's actually a nice bridge to sort of the next two questions on here, which are kind of about industrial policy. And I do want to get into your bridging your financial mechanism, so I'm going to follow up after these with some questions on that. But just these last two in the Q&A right now. Is there an opportunity here to make some real movements about bitumen beyond combustion, or looking at something like almost a supply management regime where we try to replace some of those imports with Canadian production to shore up that market? Is there any scope for that working? Is there any efficiency there? And I think I kind of know the answer, but I'll leave the ball in your court.
Okay, so I was another role I had. I was with the Alberta Petroleum Marketing Commission and part of the Alberta government for a few years, and I got involved in a number of these ideas. So my thoughts: bitumen beyond combustion is the idea about taking bitumen and turning it into some usable products that are, nanotubes and all kinds of things like that have a lot of potential. But in my view, like, we produce 3 million barrels a day of bitumen. That's a lot of volume, and these things are helpful at the edge of our market, but aren't likely to address the size of the resource we have, the level of production we have, and what we need to do with that. So yes, let's keep doing that, but I don't see it as an answer. When we look at pipelines, so Energy East was going to be a 1 million barrel a day pipeline going to St. John, New Brunswick. The Irving refinery, which is Canada's largest refinery, was the destination essentially. And that refinery currently imports a lot of oil from Saudi Arabia, the US, and other places. It makes refined products that it ships into Ontario, Quebec, and down the eastern seaboard. So if we could have had that pipeline, it was, in my mind, very likely Irving would have built the processing units to allow them to process bitumen into refined products. That would have been a big capital investment. That was why a lot of folks in New Brunswick were so keen on seeing the pipeline get built. That would have added, let's say, 100,000 barrels a day of demand for bitumen in that East Coast market, and would have opened up export opportunities for the balance of the pipeline's volume, so 900,000 barrels a day. So there was a good business rationale for it. It didn't go, and it was a very expensive proposition, and I doubt it will ever see the light of day again, just because there's just not enough production growth in our future here in Alberta to put a 1 million barrel a day pipeline back into our mix of ideas.
Yeah, I mean, that sort of fits with what my expectation was, but I think you said it more eloquently than I could have. So we're coming up on 11:30, but we've got one really good question in the chat that I want to go to. So instead of exercising my prerogative as moderator and ask my question, I am going to defer to the chat question, and I'll read it verbatim for you. What is your response to those who say that in the long run, decarbonization is occurring, leading to less global oil demand eventually, and thus Canada shouldn't be bailing out an industry that will be in decline in the next years or decades to come?
Yeah, I think that's a great question. And, so what I've been looking at for, and I'm going to try and share my screen again, and give me a minute to flip to a couple charts here. Go through my pack if I can. So the big question to me is when and how. And so there's a lot of ways to look at that. Hopefully everybody can see this graph. This is a graph that was pulled together by the World Energy Council, and it looks at scenarios for the future for oil production. And on the left, they put a bunch of these forecasts in as what's called plausible scenarios. So you can see the history part as consumption grows at 2% a year, something globally, 1.5% a year. And you can see how plausible scenarios, meaning based on what we know about, oil demand is driven by population primarily, and we're going to have a couple billion more people in the world over the next couple decades, and people moving into the middle class, and there's couple billion people in Asia who are going to do that over the next couple decades. Those are fundamentally huge drivers for oil demand, very difficult to change. So that's why the curves tend to start to go up over the next couple decades. These things are offset by efficiency in housing, efficiency in buildings, efficiency in transportation. That's a huge one. So those set of what's called plausible scenarios would see oil demand growing for probably another 10 years or so, and then starting to turn the corner. If you look at outlooks, these are a number of other scenarios that say, we may not actually achieve all those things as well as we want, and most of those tend to go fairly continuous growth. And then you look at a set of scenarios that are called normative scenarios that say we must achieve 2 degrees global greenhouse gas or global temperature increase, or we must achieve 1.5. And in order to do that, this is what must happen to oil production, consumption. So that's what the grouping is on the right. And so in the context of where the world is going and greenhouse gases, there will be a need for oil production for a long time. It's fundamental to transportation. And as long as the population and the GDP of the world is continuing to grow, there'll probably be a driver for that. The question becomes, how efficient can we be? Are there other technologies that are going to replace us? Even these things are counting electric vehicles and all kinds of things under these scenarios. And if people are interested, the World Energy Council report is really very readable. And so that's kind of what I say is, right now, we're all in our houses. We can see the impact that not driving makes, that not flying makes. It's having a big impact, and it's possible. But we also see what impact that has on our lifestyles, right? So as we come out of this, we may all make choices to do less driving and less flying and less cruise ships, and that'll all be helpful. But it doesn't move away from the fact that we probably still need 80 or 90 million barrels a day of oil. And then one other chart I wanted to show you is, this is a kind of chart that shows what happens. So if you look at the graph on the left, stated steps is a stated energy policy scenario for oil. So you can see the 100 million barrels a day of demand over a period to 2040. And what it's trying to say is, if and then the green line is this sustainable development scenario that they put out. So you can see the difference between taking dramatic action versus kind of business as usual steps. But beyond that, the decline rate for reservoirs around the world is what's happening in those purple things. And so that fracking that we talked about in Texas has a decline rate that's very steep. And if there's no new investment, production's going to ramp down in the US pretty quickly. Lots of other places in the world are like that. So you need new investment just to keep the oil production level where it is. Oil sands are quite a bit different. We have reservoirs that essentially have flat production for 30, 40 years. So we can maintain our production without a lot of new investment just by maintenance capital from our existing investments. So, all I would say is we do need to decarbonize the world. This helps us understand some of the things we can do to change our behavior and what the impacts of those things are. There will be a need for oil. Alberta is a small piece of providing that supply to a growing world.
Sorry about that. Couldn't get myself off mute. Thank you very much, Richard. I see now that we're just out of time. We're just past 11:30, and I know that you and I could keep talking about this all day. I'm sure everyone in the chat could keep talking about this all day. But pretending that I'm on the radio here, I'm going to say always leave them wanting more. So we'll end it there, and we'll probably try to have you back at some point because there's lots more material here to mine. But I want to thank you very much for talking to us and talking to the audience today. I want to thank everyone who logged in. Like I said, we're hoping that this is sort of the first in a series of these. If they continue to go well, that's great. We'll keep doing them. So stay connected, but stay apart. Thanks, everyone.
Thank you. I appreciate the opportunity.